There is something quietly happening across America right now that almost no senior is aware of. Every single year, millions of retirees over 65 are paying tax bills they do not legally have to pay at all. Not just one tax, and not just two, but 7 distinct types of taxes, fees, and bills that automatically get added to autopay and quietly drain retirement savings month after month and year after year. And the worst part is, nobody, not the Internal Revenue Service, not your state, and not your county, is ever going to call you and explain that you may already be exempt from these heavy financial burdens today. I want you to take a moment and think about this. After working for 40 or 50 years, after paying into the system your entire adult life, after finally reaching the age where retirement brings deep relief, you continue to receive bills that you may have been legally exempt from for years already, and the money has been going out the door, sometimes thousands of dollars at a time, because nobody told you it did not have to. By the end of this video, you will know exactly what those 7 tax bills are, who qualifies for the exemptions, and how to find out if you are one of them. So before we go any further into the details today, if you, your spouse, or a parent is over 65 and still paying any kind of tax bill, please stay with me until the very end, because this information could quietly save your family thousands of dollars this year. This hidden knowledge will protect your wealth every single year for the rest of your life as you watch Retirement. Watch, where we explain Social Security, Medicare, taxes, and retirement rules in plain English. We provide this crucial information so you can make informed decisions with confidence. And I am Robert Hale. If videos like this help you feel more prepared and more protected, please subscribe to this channel. Please subscribe right now and turn on the bell, because the reason this matters so much is simple. Tax laws in America are written with hundreds of exemptions, deductions, and credits designed specifically for seniors. But the system is not designed to help you find them. The bill simply arrives, you pay it, and the cycle continues. Until somebody finally takes the time to explain it, which is exactly what this channel does. We take the complex tax laws, the hidden exemptions, the rules, and we break them down clearly, calmly, in plain English. So the seniors who deserve to keep their own money actually get to keep it for themselves. The retirees who know about these programs save thousands every year, while the ones who do not just keep paying money they could have kept. So please hit that subscribe button, turn on the notification bell, and let us walk through the 7 tax bills you may be legally exempt from in 2026, one by one, starting with tax bill number 1. Property taxes represent the largest and most common tax bill seniors pay when they may not legally have to, based on regional exemptions offered by local tax districts to resident homeowners. Almost every state in the United States offers some form of property tax relief for seniors over 65, including senior homestead exemptions, property tax freezes, and circuit breaker programs for residents. They also offer Veterans plus Senior combined exemptions and senior deferral programs, where the names change from state to state, but the underlying idea remains exactly the same for all qualifying individuals. If you are over a certain age, and in some cases if you meet certain income limits, your property tax bill can be reduced, frozen at a previous year amount, or in some states completely eliminated for good. The savings can be truly enormous, depending on your state, your county, and the value of your home. The right exemption can save you anywhere from a few hundred to several $1,000s per single year. And these savings continue for the rest of your life, as long as you remain qualified. But the common mistake is assuming that the county will automatically apply the exemption when you turn 65 today. They will not apply it automatically. You have to apply often within a specific window each year. And the seniors who miss the window often miss the entire year of savings, which is a terrible financial loss. If you have not specifically asked your county tax assessor about senior property tax relief, this could be one of the most important phone calls you make this week to secure your financial future for good. Even a single conversation can lead to thousands of dollars in savings every single year going forward. And in just a moment, I will tell you about the second tax bill, which catches almost everyone by surprise. This next financial burden catches almost every American senior by surprise because it is hiding inside your annual federal tax return. So just stay with me as we uncover tax bill number 2 right now. The extra federal standard deduction for seniors is hiding in plain sight on every single federal tax return filed by a senior in America. Yet most retirees do not realize it exists for their benefit. Most retirees do not realize that once you turn 65, the Internal Revenue Service gives you an additional standard deduction on top of the regular standard deduction that everyone else receives normally. For 2026, that extra deduction can be approximately $2,000 for single filers and even more for married couples where both spouses are over 65 years of age at filing time. This extra deduction directly reduces the amount of your income that is subject to federal income tax, which, over a typical retirement, can save thousands of dollars in federal taxes you would have paid. And here is the part that surprises many seniors. If you have been taking the standard deduction since turning 65, but not specifically claiming the extra senior amount, you have been underpaying yourself. You may have been underpaying yourself for years, and the common mistake is using last year tax preparation software, last year CPA notes, or last year return as a template without adjusting for the change. You failed to adjust for the extra senior deduction when you turn 65, and the Internal Revenue Service does not call you on your birthday and explain this to you, as they simply process what you submit. They simply process whatever you submit. So if you are not sure whether you have been claiming the additional senior standard deduction, take this year return to a qualified tax professional immediately. Ask them specifically to review the past 3 years, because in some cases, prior year returns can be amended to recover overpaid taxes, which injects thousands of dollars back into your retirement account. Tax bill number 3 is the state income tax on Social Security benefits, which most Americans know can be partially taxable at the federal level based on their overall provisional income thresholds. But what most seniors do not realize is that the rules at the state level are completely different, and in many cases, far more favorable for retirees looking to maximize their monthly cash flow today. Currently, the majority of states in the United States do not tax Social Security benefits at all, as some never have, while others have phased out their Social Security taxes in recent years for residents. And among the states that still do tax Social Security, many offer significant exemptions or reductions specifically for seniors. So if you live in a state that does not tax it, this may not apply. But if you live in one of the few states that still does tax Social Security, or if you are not sure, this is a question worth answering this week to stop unnecessary financial bleeding from your funds. Some retirees have been paying state income tax on their Social Security for years when they were actually eligible for a senior exemption or partial deduction the entire time without ever knowing it. Others may benefit from adjusting their tax planning to reduce that tax going forward, because the common mistake is assuming that if state income tax was withheld in the past, it must be required by law. It is not always required, and the rules change constantly as new laws pass and new exemptions are created, meaning what was true 3 years ago may not be true today in your specific jurisdiction. This is one of those areas where a one-time consultation with a qualified tax professional in your specific state can pay for itself many times over by shielding your retirement benefits from state taxes. Tax bill number 4 is the capital gains tax on the sale of your home, which is one of the most important tax rules in the entire retirement system and also one of the most misunderstood by homeowners. Under current federal tax law, when you sell your primary residence, you may be able to exclude up to $250,000 of capital gains from federal taxes if you file as single. And you can exclude up to $500,000 if you file jointly with your spouse, which is a massive tax shelter designed to protect the home equity you built over your working lifetime. To qualify, You generally need to have owned and lived in the home as your primary residence for at least 2 of the previous 5 years before the date of sale, which is a very standard requirement. For many seniors who have owned their home for decades and seen significant appreciation, this exclusion can save tens of thousands, sometimes hundreds of thousands of dollars in federal taxes when they sell. And yet, every year, retirees sell their homes without fully understanding this rule, without planning the timing carefully, and without consulting a qualified tax professional, which causes massive errors. The mistakes can be incredibly expensive, and the common mistake is assuming that selling a home in retirement automatically results in a large tax bill that you are forced to pay to the government. For most seniors, selling their primary residence after living in it for many years, the opposite is often true, because, with proper planning, much or all of the gain may be completely tax-free for you. Before selling your home in retirement, take time to understand exactly how this exclusion applies to your specific situation, as a qualified tax professional or real estate attorney can help you avoid mistakes. They can help you avoid mistakes that cost tens of thousands of dollars. So, here is a quick reminder before we keep going. If this kind of plain English explanation is helping you, please subscribe now. Please subscribe to Retirement Watch and turn on the bell because we post new videos every week breaking down exactly these kinds of tax exemptions and rules in language that respects your valuable time. Our channel always respects your time and your intelligence, because the seniors who stay informed save thousands every year, while the ones who do not just keep paying money they could have kept. So please hit that subscribe button now if you have not already done so as we move into Tax Bill number 5, which is vehicle registration and Department of Motor Vehicles fees across the nation. This is one of the most overlooked tax bills in America, and one where the savings are quietly available in almost every state, year after year, for seniors who simply take the initiative to ask. Many states offer senior discounts on vehicle registration fees, license plate fees, driver license renewal fees, and certain other Department of Motor Vehicles related charges that hit your wallet annually. The savings per item may seem small, but over a typical retirement, they add up to hundreds or even thousands of dollars that remain in your checking account instead of going to state agencies. In some states, seniors over a certain age can register a vehicle for a reduced fee or even pay no annual registration fee at all for certain types of vehicles, which provides great breathing room. Other states offer free or discounted state identification cards in place of driver licenses, free vehicle inspections, or extended renewal periods that reduce how often you have to pay fees. The common mistake is assuming that if a senior discount existed, the clerk would have applied it automatically, but they will not apply it because the discount is on you to ask about and apply for. It is entirely on you to specifically apply for it, so before your next vehicle registration renewal, before your next driver license renewal, or before your next visit to the local office, take action. Take 5 minutes to call your state office and ask if they have any senior discounts you might qualify for, because that single question can save you money every single renewal cycle for decades. And in just a moment, I will tell you about the 6th tax bill, which most seniors do not even realize is a tax until they get caught by it. So just stay with me as we unlock this secret. Tax bill number 6 is medical expense deductions, which is technically not a tax bill in the traditional sense, but rather a deduction that, if used correctly, can reduce or completely eliminate taxes. It can eliminate part of your federal income tax bill, yet almost no senior uses it to its full potential under current federal tax law regarding qualifying medical expenses that you pay yourself. Qualifying medical expenses that exceed 7.5% of your adjusted gross income may be deductible if you itemize your deductions on your federal tax return instead of taking standard. For seniors with secondary medical costs, including health insurance premiums, prescriptions, dental work, vision care, hearing aids, medical equipment, and long-term care expenses, this can be enormous. Many retirees do not realize that even Medicare Part B and Part D premiums paid through deductions from their Social Security check count toward this deduction alongside supplemental insurance premiums. So do certain home modifications for medical reasons, transportation to medical appointments, and many other expenses most seniors never track because they assume these everyday costs do not qualify at all. The common mistake is assuming that the standard deduction is always better, even when total medical expenses are exceptionally high during the year due to health challenges or necessary procedures. For some seniors with significant medical bills, itemizing and claiming the medical deduction can result in much lower federal taxes at the end of the year, which saves their precious savings. Before your next tax return is filed, talk to a qualified tax professional about whether itemizing makes sense for your specific situation, and keep careful records of every medical expense, always. The seniors who track their expenses save thousands of dollars, while the ones who do not just take the standard deduction and lose the benefit completely, which is an avoidable financial mistake. Tax Bill number 7 is the property transfer tax and gift tax on family transfers, which is one of the most overlooked taxes in retirement planning and one of the most expensive when wrong. When seniors transfer property to their adult children, grandchildren, or other family members, certain taxes can apply, depending entirely on how the transfer is structured by the parties involved. Property transfer taxes, gift taxes, capital gains issues, and state-specific rules all interact in ways most families never anticipate when attempting to pass down wealth to the next generation. The good news is that many states offer specific exemptions for parent-to-child and grandparent-to-grandchild property transfers to preserve family homes and wealth without government interference. Some states allow the family to transfer ownership of a home without triggering full property tax reassessment, which can save the next generation tens of thousands of dollars in property taxes. The federal gift tax exclusion currently allows individuals to gift a certain amount per year per recipient without triggering federal gift tax consequences or requiring immediate tax payments. For married couples, that exclusion can double, allowing significant wealth transfers completely free of tax implications if structured correctly before any paperwork is officially filed with the county. The common mistake is making a property transfer to a family member without understanding the tax consequences in advance, as a well-intentioned gift can sometimes trigger thousands in hidden taxes. It can cause lost property tax exemptions or future capital gains issues for the recipient. So before transferring any significant property, real estate, or large financial gift, take time to consult. Consult with a qualified tax professional or estate attorney because the cost of the consultation is a tiny fraction of what you could save by avoiding a single expensive mistake in your planning. Now let me bring everything together with a calm checklist you can use right now, no matter what state you live in, to ensure you are not overpaying the government a single dollar this year. 1. Call your county tax assessor and ask about senior property tax exemptions, freezes, circuit breaker programs, veterans exemptions, and deferral programs available in your local county right now. 2. Confirm with your tax professional that you have been claiming the additional federal standard deduction for seniors on every return since you turned 65 to maximize your tax shelter. If you have not been claiming it, ask whether prior year returns can be amended to trigger a retroactive refund from the Internal Revenue Service for all those missed years of savings. 3. Find out whether your state taxes Social Security benefits, and if it does, whether you qualify for any senior exemptions or reductions by speaking with a qualified state tax professional. 4. If you are considering selling your primary residence, talk to a qualified tax professional or real estate attorney about how the federal capital gains exclusion applies to your situation. Make sure you have this critical conversation before you list the home on the market so you can structure the timing perfectly to avoid any unnecessary capital gains taxation on your equity. 5. Before your next Department of Motor Vehicles visit, call your state office and ask specifically about senior discounts on vehicle registration, license renewal, and identification card fees today. 6. Keep detailed records of every medical expense you pay each year, including Medicare premiums, supplemental insurance, prescriptions, dental, vision, hearing, and medical-related transportation costs, always. At tax time, ask whether itemizing and claiming the medical deduction would benefit you more than taking the standard deduction based on your total out-of-pocket healthcare expenditures that year. 7. Before transferring any significant property or large gift to a family member, consult with a qualified tax professional or estate attorney to understand the federal and state tax consequences. A single hour of planning can save your family tens of thousands of dollars because these are not gimmicks and these are not loopholes, but real rules written specifically to help American seniors. These are real federal and state tax rules written specifically to help American seniors keep more of their own money, as the retirees who know about them save while the others just keep paying. And now for an important reminder that this video is educational only, and it is not financial, legal, tax, medical, Social Security, or Medicare advice for your specific personal situation today. Retirement Watch is not affiliated with the Internal Revenue Service, any state department of revenue, any county government, the Social Security Administration, Medicare, or any government agency at all. Eligibility for any program, exemption, or deduction depends entirely on your individual situation, your state, your county, your income, and other complex factors that vary wildly across the entire nation. Tax laws, exemption amounts, and qualification rules change constantly, so always verify your specific eligibility with your local county tax assessor office or your state Department of Revenue. You can also check the Internal Revenue Service website or consult a qualified tax professional, estate attorney, or financial advisor who knows the rules in your specific area before acting. If you have made it this far in the video, thank you, honestly, because the fact that you sat through this entire conversation already puts you way ahead of most American seniors today. You are doing exactly what the retirees who keep more of their money do by slowing down, paying attention, and learning the rules before somebody else benefits from your financial ignorance. That single habit, more than any single financial trick, is what separates a comfortable retirement from a stressful one filled with constant anxiety over bills and depleting savings accounts. If this video helped you, please subscribe to Retirement Watch and turn on the bell as we post new videos every week explaining Social Security, Medicare, taxes, and retirement rules in plain English. We use the same calm, no-pressure approach you saw today because the seniors who follow this channel save thousands every year, while the ones who do not just keep paying unnecessary bills. And please, share this video with someone in your life who could use it, like a parent, a sibling, a spouse, a neighbor, or a friend at church who might be overpaying their taxes right now. Sometimes the most loving thing you can do for the people you care about is forward them a video they did not know they needed to watch to protect their hard-earned retirement wealth. A short conversation today, started by you sharing this video, could save someone you love thousands of dollars every year for the rest of their life, which is an incredible gift to give them. Before you go, I would like to hear from you, so please comment below which of these 7 tax bills surprised you the most during our breakdown today so we can discuss it further together. Was it property taxes, the extra federal standard deduction, state income tax on Social Security, capital gains on your home, vehicle fees, medical deductions, or property transfer and gift taxes? I read those comments thoroughly, and they help me decide which topics to cover in more depth in future videos to help you navigate your retirement with maximum financial safety and confidence. I am Robert Hale, and this has been Retirement Watch. So please, take care of yourself, take care of the people you love, and I will see you in the next video as we continue to learn together.